So this is the story of a dollar. So Vladimir Lenin, like the leader of the Soviet Union, said that there are decades where nothing happens, and then there are weeks where decades happen. So the past few weeks might have seemed like decades happen because everything has changed. Our lives have changed. Businesses have changed. Schools have closed. The stock market has dropped, so it has changed a lot. So this is the growth of $1 from 1914 to 2020, and this shows how that $1 has done over a course of 106 years. So from the first 60, 70 years, we can see it looks like a flat line. It looks like nothing has happened, right? And this is called the linear scale. So it looks like nothing has happened, right? But if we look at a semi-log scale, where on the y-axis each interval is times 10, we can see that a lot has actually happened in those first 60 years. There have been many drops, like from around 1930 and stuff like that. We can see how the dollar has done. So the flat line here compared to this line here looks very different.
It's the same data.
Same data, yeah.
Same data, but
different like scale.
Different scale, right? So even though it appeared like a flat line, but a lot was happening during those times. And we'll go through some of those events, right? You're going to run through some of those events?
Yeah.
Okay. Mostly bad, I assume?
Yeah.
Okay.
So if we look at this chart, which shows like money put in and over time, like how each year the market has done like growth or decline.
By the way, what are we comparing? When you said you put dollar into the market, which market are we talking
about?
The
US stock market. And the US stock market, because in the past other stock markets might not have been as reliable as the US one. So
you might not have as reliable as data.
Yeah.
So that's why you're using US stock market as a proxy?
Yeah, to base it off other ones, like overall. Okay, so we can see that some years it has gone up, some years it has gone down, and so some years the amount that is calculated either has gone down or up is like the average of the entire year. So if the market has gone down 25% in 1 year, some days the market might have actually gone down 60% and recovered, and the average was 25%.
No, not average. From the start to the end, if you put in with dollar.
The start to the end.
It's the start of the year and the end of the year, right? So if you started off with $1, you ended up with $1.25.
25%.
Then it's 25% gain. Yeah. But if you ended up with 75 cents, then it's a 25% loss.
Yeah.
Okay. So it is showing you annualized gain or loss, profit or loss, right? Go ahead.
So this chart here shows like when the market has declined and how long it takes for it to recover. So at the start from 1914, it declined, and it took about 3-4 years for it to come back or like reset, you could say. So if you put in $1 in 1914 and it went down 25%, so it would be 75 cents. It would take about 3 to 4 years for it to become $1 again, and then it might grow from there. But we can see here it declined again to maybe 30-40%.
So basically it is peak to trough decline. And how long did it take for your portfolio to surpass the previous peak? Okay, so if you started off with $100 portfolio, and if it declined 25% and you had to wait 4 years, how long did it take you to take your portfolio to come back to $100 and surpass that? Okay, so it is just showing you different time frames during this entire period where you would have to wait for a long time, and those long time could be years and sometimes a decade, right?
Can see.
And so are you going to be happy having a decline like that, like right now?
I would be happy.
You would be happy?
Yeah.
Why?
Because then you could buy more.
Buy shares. More of what?
More shares of a company at a cheaper price.
What do you mean by shares?
Like more fractions of a company.
More fractions. So you're basically buying a bigger share of the company, right? Okay.
So this chart, the yellow chart compared to the red chart, now we can see like all the dips in the yellow chart, we can see compared to the red chart. So around 1915, we can see that the market dropped and recovered around 1919. So that took about 3 to 4 years. So in the red chart, we can see the first drop took about 3 to 4 years to recover back to the original point where you started. So same with like 1930, it took maybe 6 to 7 years. So we can see the big drop on the red chart.
So it's just measuring the amount of time it took you to recover from that, right? And sometimes you have to wait for a long time. And when you say recover, you're talking about your portfolio to recover, right?
Yeah.
What do you mean by your portfolio?
Like companies in the US.
Why did you? Oh, so you were just picking US.
Yeah.
So basically, your investment in this stage, when you're watching this dollar grow, it's invested in a collection of US companies, right? But at the same time, you could be invested in a global portfolio, right? Same kind of situation, right?
So now we can go through all the bad that has happened from 1914 to 2020.
So all the bad which have caused your markets to go up or down, right? Most likely down, right? And why are you not recounting all the good stuff?
Because good stuff, happens all the time, right?
All the time, and bad stuff is when people
freak out.
So people freak out, right? And what makes news is all the bad stuff, right?
Yeah.
Nobody says, there was no crime today, so that we are not going to report any.
Yeah.
We are going to report the fact that there was no crime today, right? And when you have a crime, even though it's a small crime, it gets reported, right?
Yeah.
Okay.
So in 1914, World War I started, and the market closed for 4 months. So.
Can you imagine that happening now?
No.
Okay.
So
4 months you couldn't buy or sell your companies, right? Even if you owned them, right? Okay.
So 1918, worldwide influenza pandemic strikes. So the Spanish flu struck in around 1918. It infected around 500 million people, a quarter of the world's population. So if that happened today, about 2 billion people would be affected by this flu. And the estimated death toll was between 17 to 50 million people. Okay. So 1929, the stock market crashes, causing the start of the Great Depression. So the S&P 500 falls significantly, and
86%.
86%. And in 1930, employment soars. So we can see on the chart.
Unemployment soars.
Unemployment soars. So we can see on the chart the big drop. 1934, we have the Dust Bowl problem continues, which is like the worst drought in 300 years, and it plagues 75% of the country. 1941, Pearl Harbor attacks US, and that causes the US to enter World War II. 1957, we have the Asian flu, another pandemic, which takes away 2 million lives. In 1964, US gets involved in the Vietnam War, and US conducts large-scale strategic bombing campaigns against North Vietnam and Laos.
1968.
1968, the Tet Offensive, American public's resistance to the Vietnam War grows. 1980, after nearly a decade of sustained inflation, the Federal Reserve raises interest rate prices to nearly 20%, pushing the economy into a recession.
Hey, when you say 20%, you know how much what was the mortgage rate at that time?
No.
Like it was like 17-18%. Imagine getting a mortgage today at 18% on a home, right? So early 1980s was one of the most inflationary times ever in the last century, and interest rates were like double digit. When you say 10-year treasury, do you know when I say what is a 10-year treasury bond? Do you know what that means?
You hold on to the bond for 10 years.
10 years. So you buy a bond for 10 years from the US government, you lend money, right? You lend money to the US government for 10 years. In those days, the interest rate was somewhere around 15-16% a year. The treasury would pay you to lend money to them. What is that same interest rate now?
Maybe 2%.
Less than 1%.
Oh.
Okay, imagine that. Okay, so now you hardly are making any money by lending money to the government. Okay.
the crash in 1987, Black Monday, the Dow Jones falls 22.6% in just one day, and it's the worst in one day since the panic of 1914. Stocks go on to not only make back all those losses, but at the end of the year, increase in 6%.
Okay, so that's what we were talking about. When you look at annualized returns, for that year, it might appear that you only made 6% a year.
Yeah.
But in that event of making that 6%, you had to suffer through that one day decline of 23%.
Yeah.
Okay, so it might actually, in all of these situations, you would have endured almost like a situation where like this is something new. This has never happened in the past, and it's the end of the world. But we are still here, right?
Yeah.
You still recovered out of it. The system recovered, and all those things, right?
What is
Okay.
I should cut this out.
Okay.
2000, the burst of the dot-com bubble, so stocks declined about 9%. In 2001, 9/11 terrorist attacks, stocks declined too. Okay, so now we're in current day, 2020, the ongoing coronavirus pandemic.
And where do you see on the plot here?
Okay, we see this small blip at the end.
Okay, and why is that really a small blip?
Not really,
Why is that not a small blip?
because over here on the x-axis, it has changed. So
On the y-axis.
on the y-axis, the intervals have changed a lot, so it's
So
actually
it's
a
a
lot.
25-30% decline, but it appears like it's a small blip.
Yeah.
And that's what a lot of these declines on a log scale look like, okay? But when you're in the middle of them, it's like the end of the world, right?
Yeah. So this might seem like the end of the world, but just to remember, these are some of the companies in the United States that I own, like I'm a shareholder of, such as like Google, Amazon, Microsoft, Facebook. And then there are companies in countries outside of the US, like all of these, like Adidas, Toyota. And I'm a shareholder of all of these companies.
Are these the only companies you own?
No,
Why?
these are just like well-known companies, I guess.
Or this is just a small collection
Yeah,
of the
small
companies you
collection
own?
of companies.
Okay. Are all of these companies going to survive by the end of this crisis, how long ever it lasts? By the way, do you know when this will end?
No,
Okay. And
but not necessarily. You don't know.
you don't know. So if you don't know, why can't you just take out the companies you think are not going to be around and only own the ones which will be around?
Because you never know. Like some people think that this might survive, but you never know.
So their businesses could change, right? You don't know which one is going to come out and survive, and how strong that business will be, right? So you want to. That's why you diversify, right?
Yeah.
That's why you own a collection of different
not
types of business.
individual.
You can own some individual if you
Yeah.
want, but as a broad portfolio which forms the base of your of everything you own, you want to own everything, right? You want to diversify as much as possible. Okay.
Okay, so we can finish off by a quote from Charlie Munger, and he said, like, if you're not...
Who is Charlie Munger, by the way?
Oh, he's like the vice president of Berkshire Hathaway.
Vice
which-
chairman.
Vice chairman, and Berkshire Hathaway is...
Maybe vice president.
You're vice president.
Okay.
Berkshire Hathaway is... Warren Buffett is the owner of Berkshire Hathaway.
Owner. Warren
No,
Buffett
not
is not
owner.
owner.
He's a founder.
He's the founder. Yeah.
And Warren Buffett's the founder of Berkshire.
Who is the owner?
Oh, shareholders.
Is
It's
that
a
you?
public company, yeah.
Is that you? Okay.
Very small
Very small. Okay.
portion of it. Okay, so he said, like, if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder. So what this means, like, you have to be willing to handle the loss of the market 50% a couple times a century.
Okay. What he's trying to say is that this is pretty normal. If you own a stock type portfolio, you should expect this kind of declines every now and then, and you should be prepared. You should be ready. There is no way around it, because you cannot anticipate this kind of declines from happening, right?
Yeah. Okay, so that's about it. So in the next couple videos, in this video, we talked about what has happened in the course of 106 years, and it's not very likely someone would be investing for that long.
Because they might not be around for
yeah,
that long.
Not be around.
And even though you lived through some of the worst period, one of the worst 35-year period, you still turned out.
Okay.
Okay. Anything else you want to add?
No.
No? Did you do a good enough job here?
Yeah.
No?
Yeah.
Should you get an award for this?
Yeah, I'm done.
Okay.